Canada shed 17,700 jobs in April. The unemployment rate climbed to 6.9%, the highest in 6 months. Youth unemployment hit 14.3%, more than double the national average. Those numbers landed on the same day Enbridge's CEO declared it the best macroeconomic environment for oil infrastructure he has seen in over a decade. That collision is what Friday's session was built around. The TSX moved in 2 directions at once. Financials held firm on the back of analyst upgrades and improving dividend outlooks. Telecom slipped. Telus reported Q1 profit falling to $136 million from $321 million a year earlier, citing intense wireless competition and a dynamic operating environment. Aritzia posted record revenue and received target price increases from BMO, Canaccord, TD, and Royal Bank, pushing the fashion retailer's stock higher, even as consumer confidence data told a more cautious story about discretionary spending. Honda's decision to indefinitely suspend its planned $15 billion EV plant in Alliston, Ontario, cast a long shadow over the manufacturing sector. Neither Ottawa nor Queen's Park had dispersed the up to $2.5 billion each had pledged, but the optics of a flagship industrial anchor walking away without a replacement plan hardened the jobs narrative. The day's undercurrent, though, was in energy. 2 Calgary-based CEOs, both reporting strong quarterly earnings on the same afternoon, reached opposite conclusions about what comes next, and the distance between those conclusions is what the market still has not fully priced. The divergence between Enbridge and Cenovus is not a disagreement about facts. It is a disagreement about which facts matter. Enbridge CEO Greg Ebel told analysts the company's $40 billion capital backlog is fully funded, demand for pipeline capacity is surging, and the global oil supply crunch driven by Middle East conflict is creating the most favorable investment climate for North American energy infrastructure in more than 10 years. The Mainline Optimization Program is adding 150,000 barrels per day in its first phase, with a 250,000 barrel per day second phase decision still pending. Rival pipeline proposals are emerging, and Ebel called that a good sign, not a threat. Competition for long-term contracts, he argued, means producers believe in the basin. Cenovus CEO John McKenzie also reported a strong quarter. Net earnings of $1.57 billion in Q1, nearly double last year. Record upstream production above 972,000 barrels of oil equivalent per day. By every backward-looking measure, it was one of Cenovus's strongest periods on record. Then McKenzie delivered a warning that had nothing to do with last quarter. Only one new Greenfield oil sands project has been approved and built in Canada since 2013. 13 years. Meanwhile, global oil demand has grown. Canada's carbon policies and regulatory timelines, McKenzie said, have made the country myopically focused on the climate agenda, at the cost of becoming one of the least attractive jurisdictions on Earth for new upstream investment. That is the fork in the road. Enbridge moves oil that already exists. Cenovus worries about whether Canada will ever build the upstream capacity to keep the pipes full past the next decade. Both arguments are correct within their own time horizon. The question the market has not answered is which horizon is relevant to the current price. This is where it gets complicated. If McKenzie is right that Greenfield development has stalled permanently, not cyclically, then Ebel's optimism about long-term pipe demand rests on a foundation that is quietly eroding. Canadian Mainline expansion is approved, but expansion into what? The Trans Mountain Pipeline opened in 2024 and redirected significant volumes toward Pacific export markets. New pipeline capacity assumptions require producers to fill them. If new oil sands capacity does not emerge, the infrastructure build-out Enbridge is executing could arrive at a demand cliff rather than a demand surge. The last time Canadian energy split along these lines was 2015. Oil prices collapsed from above $100 to below $30. Pipeline stops held materially better than producers. Midstream contracts are typically take-or-pay, meaning pipeline operators get paid whether volumes flow or not. Producers like Cenovus were forced to cut dividends and defer projects. Enbridge's stock fell, but never broke the way upstream names did. The midstream insulation thesis is not new. What is new is McKenzie's claim that the problem is not cyclical oil price risk, but structural policy risk, the kind that does not reverse when prices recover. If McKenzie's diagnosis is right, the 2015 parallel actually works against Enbridge in the long run. In 2015, the assumption was that once oil recovered, Canadian producers would resume their investment programs. They did, partially. But McKenzie's data point is that since 2013, only one Greenfield project has made it through approval and construction. Not because oil prices were wrong, because the regulatory and carbon cost environment made the economics unworkable regardless of price. The condition that would resolve this in Enbridge's favor, a Canadian policy shift that restores Greenfield economics before the existing oil sands production base begins its natural decline. The industry has flagged 2030 as the approximate window when growth from existing projects without new Greenfield starts to flatten. That gives roughly 4 years. The condition that would resolve it in Cenovus's favor, meaning the warning becomes a self-fulfilling spiral, is continued regulatory inaction, with capital continuing to migrate to the Permian Basin and the Middle East, where permitting timelines are measured in months, not years. One concrete benchmark to watch, the federal government stands on the CUSMA review, now made more complicated by a recent U.S. Supreme Court ruling, which BNN Bloomberg flagged as adding pressure on Canadian trade exposure. If post-tariff policy creates new incentives for domestic energy investment, that is the reversal signal for the Cenovus thesis. If the CUSMA review produces additional uncertainty without a corresponding liberalization of energy permitting, Mackenzie's warning looks more durable. Canada's unemployment rate is already at 6.9%. The manufacturing retreat signaled by Honda's exit is already in the headline flow. Energy is the sector where Canada still has structural advantage, and 2 of its most senior executives are publicly disagreeing about whether that advantage is being preserved or spent. That split, not the quarter's earnings numbers, is what the next 6 months of Canadian equity positioning will have to navigate. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.